Welcome back. Today we're diving into the latest on SCPH cash out and CVR updates. Steel prices are sliding and margin debt is hitting record highs. What does this mean for you? Plus, Nvidia just had a stellar quarter, but they're facing some serious headwinds from China. Stay tuned for the plain English PE playbook at the finish. Let's break it down together.
Hi, Deep Thinkers. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our guest host, Mark Rosano. He is the founder and CEO of C6, an energy-based fund. Mark, how are you doing today? And what are you doing to celebrate Labor Day?
Oh, good. So it's the last day that the town pool is open. So I promised my kids that I would spend the afternoon with them before the pool is shut down for good, and they go back to school tomorrow.
Wait, they've got to go back to school one day after Labor Day?
Yep.
Wow, that is
Oh yeah.
they keep things tight there.
Oh, I know, but at least they got an extra week and a half, 2 weeks versus the rest of the country. So it's a good balance.
Yeah. All of the DKI interns, I believe, are back to school already.
Yes.
Yeah. All right. So thank you so much for guest hosting. We decided to give Rob Farian the long weekend off. We've got the medical device takeover issue. But Mark, the last time you hosted, we got a ton of great feedback about you. So why don't we get ourselves started?
Sure. So we'll kick it right off. So you mentioned the MannKind to acquire SCPharma. So just like for those that don't appreciate or don't know too much about M&A, there's always a lot around it. Is what is the premium? Is there any additional uplift? So given the fact that you guys were early and right on this, I'd love to hear kind of what your take is on the value of this deal. Could there be another bid waiting in the wings? And if not, is there going to be some uplift if they get that FDA approval that you spoke about?
Yeah, so great questions. Let's first talk about SC Pharma and then we'll get to the deal. SC Pharmaceuticals makes a drug called Furoscix, and it's a diuretic that's used for congestive heart failure or chronic kidney disease. When people have those diseases, they have what are called swelling incidents, where they retain fluid and everything swells up, and it's incredibly uncomfortable and can be dangerous. Prior to SC Pharma, the standard of care had been to hospitalize people or send them to an infusion center and give them an IV diuretic. That is extremely expensive and it's also dangerous. You go to a hospital, you're likely to end up with other diseases. And it's also uncomfortable. People don't like doing it. SC Pharma allows people to be treated at home and it saves CMS, that's the agency that administers Medicare, 75%. It is one quarter the cost of sending somebody to the hospital. So, this was an idea that was suggested by Dr. Paul Thompson. He's a member of the DKI Board of Advisors. He's a cardiologist. He was also the person who suggested Shockwave, where we got a 70% return in just a few months last year. But anyway, that's why we owned SC Pharmaceuticals. It was a huge position for us, more than a 10% position. And the merger premium or the acquisition premium was a 31% premium to Friday's closing price. The deal provides for 535 a share in cash, plus a contingent value right that's worth up to $1 a share. The contingent, that's hard to say. The contingent value right will be based on SC Pharma getting FDA approval for something called their auto injector next year and annual revenue reaching $120 million by the end of 2026. I think you're going to get the full dollar per share, and that's why I think you're getting a full 31% premium. The takeover price, depending on where we bought in, was a 40 to 50% plus premium from our initial purchase price and average purchase price. So DKI subscribers did really well. Your question was about the valuation, and I think it's kind of light. This was about 2.5 times next year's revenue for a company that's growing more than 100% this year. They grew more than 100% last year. Last quarter, the annual growth, again, more than 100%. Projected growth for next year is still more than 80%. So that to me seems kind of cheap. I think the probability that you get the full dollar on the CVR, that's the contingent value, right, is very high. And the probability that like Johnson and Johnson, Boston Scientific, or Medtronic come back with a higher bid here, they could certainly pay 3, 4, 5 times revenue without stretching themselves. This is a small cap company. I think the probability of something like that is in the range of 5 to 10%. I was kind of surprised that management agreed to a deal this cheap, but I think part of it was just such a huge premium. This is also a stock that was trading below $2 earlier this year. And, the final acquisition price, I think, is going to be 635. So, they were getting more than triple where the stock was, just months ago. I think that makes it really hard for management to turn down a deal like this. But to me, if I were J&J, Boston Scientific, or Medtronic, I'd be taking a look at this one.
Now, so two questions off that, and I'll start with one of them. Do you know I mean, do we know what the deal looks like? Is there a ROFR or right of first refusal where if there's another bid coming in, the current person acquiring has the right to try to match and or beat whoever's coming in?
Yeah, so when this deal was announced, the merger agreement hadn't come out yet. I actually need to take a look through it. So I'm not sure, but typically with things like this, if you are the acquiring company and you're offering the big merger premium, typically with something like this, you're just going to have like a big breakup fee, which
Right.
again is the kind of thing at 2.5 times revenue for a company growing more than 100% top line. It's the kind of thing that, a Johnson and Johnson could pay down easily. The value here, I mean, it's under $500 million. The valuation of the company is just a couple $100 million. So, any takeover, sorry, any penalty price for that is easily
Right.
paid.
So one of the last questions, because I did biotech for a small stint in my career, and it can be complicated because there's a lot of FDA nomenclature. There's a lot of different approval processes, different phases. But one of the big issues which could create some of the discount is that the company that's being acquired has the right to the drug, but doesn't have the sales force, the distribution, the manufacturing, which are all very expensive to do and would require additional capex, whether that be from an equity raise, whether that be from a debt raise. Is that something that could weigh on the premium that they get because the acquiring company is going to have to either restructure some of their manufacturing or build out new manufacturing to deliver this to market?
Yeah, great question. So first of all, the manufacturing isn't an issue because that's outsourced for this company. scPharma last year ended up getting some approvals that they were hoping for, and they increased their sales force. So they actually have a much larger sales force that's just starting to produce results within the last quarter. And also in the first quarter of this year, they got the approval for CKD, that's chronic kidney disease, and for class 4 CHF, that's congestive heart failure patients. So there's still a ton of growth here, but certainly, a company with an existing sales force can benefit from that. And again, that's one of the reasons why I suggested, a larger company like a Johnson Johnson or Boston Scientific might be interested. They already have the sales force. They're already talking to these people. But it's one of the things that's exciting about the company. There's a lot of growth that they have access to simply because, they've just gotten all of these new indications that they can sell into, and they've just added additional people to the sales force.
So before we go to my favorite comments and questions about steel demand in the U.S., one last piece. So when you're looking at this drug, so for those that don't know, if the FDA is one of the hardest places to get approved. So if you usually get approval in the FDA, you'll get fast tracked in other countries. There's even other countries that have reciprocity where if you have FDA approval here, you can quickly move into other regions. But a lot of times there'll be other drugs that could be, or other equipment that is competitive, but they don't have FDA approval, but they're used in Europe, they're used in India, Latin America. Is there anything that would be a hindrance for them expanding into other nations, other regions, or is this something that could be adopted quickly as you look into a global distribution?
It would be super easy to do. The fact is that, first of all, these are diseases that are worldwide
Mhm.
issues. Um, and you're talking about a diuretic, right? There's really nothing special about a diuretic. The key point on it is that SC Pharma's solution allows people to be treated at home. And you can say, well, wait, what, why is that a big deal? And it has to do with the pH level of the existing standard of treatment. So the current standard of treatment has a pH level that has to be delivered. It can't be delivered subcutaneously. It has to be delivered intravenously. That's why you have to send people to the hospital or to an infusion center. What SC Pharma did is they found a way to formulate a more neutral solution where people could take it subcutaneously. And so if any of you have ever seen somebody who has, or if you have diabetes, there's people, they have like the insulin pumps. It's like a little box, maybe smaller than a deck of cards that they wear on their skin with a small needle on it, and it delivers that insulin throughout the day. What SC Pharma has is something that looks very much like that and delivers over about 5 hours and allows people to stay at home where it's safer and they're more comfortable. Now, the auto injector we talked about is incredible technology because that allows the drug to be delivered pretty much instantly. It would take about 5 or 10 seconds. Um, and so they would just, apply it like to their belly and push a lever, and the drug would be delivered, and the diuretic would work over a multi-hour period. And so we're just talking about something that's really simple to use. But I don't think this isn't like cancer where treatment is very complicated and regionally based. It's a diuretic. The solution for SC Pharma isn't that we've reinvented the diuretic, it's that it's the delivery mechanism that makes it different.
Yeah. I mean, and that's always big when you're looking at the adoption because typically, everyone wants the lowest cost solution. So if it's something that is faster, cheaper, easier, and better results, I mean, it's something that'll get adopted rapidly, especially when you look abroad. So just shifting gears because I've been dying to talk about steel demand and
Yeah.
commodities in general because it is a passion. But when you look at the different pieces and trying to kind of sniff out, is the economy slowing? Is it growing? People will always start talking about steel demand. Where is steel capacity? Where is steel demand? Because steel is obviously going to be pivotal to a lot of things. We've built out some of our mini mills or those electric arc furnaces where you take scrap metal and turn it into new metal. Now that can be used for most things, not all things, which is why we're always going to have blast furnaces where you're going to make brand new steel from your typical process. So when you start looking at, some of the things that you're thinking, when you look at demand being lower, but yet tariffs should be helping by keeping some of that steel off the coast, what are you kind of seeing, or what is your inclination when you see this type of demand struggle?
Yeah, so Mark, I think that's the key point, right? What's happening with tariffs. And one of the reasons why, you know, when President Trump announced tariffs, right? Every macro person, every economist on Twitter or X, they went hyperbolic. They started whining and crying. They went crazy. Oh no, he's going to ruin the economy. And the reason why I was much less reactive and much less concerned about it is because people adjust, right? If you start to block foreign suppliers, you get an increase in domestic supply. Well, guess what? That's exactly what we had here. Domestic steel mills have been ramping up their output, and underlying steel demand isn't growing as fast. And, we can have a debate about how good the economy is, but I've been saying for years that our GDP numbers have been faked. And the reason they're faked is because government spending, whether it's productive or not, and most of it is not productive, adds to GDP, right? So they throw money at something and say, hey, look, we've created GDP. No, they haven't. They've just spent money and added to the debt, but they get to add it to GDP. They haven't really created anything productive. So what's happened here is domestic steel mills have ramped up output. They've increased capacity. Time-sensitive orders are getting filled. Steelmakers have found themselves cutting prices to chase sales. Hey, Mark, do you remember just a few weeks ago when President Trump was talking about steel tariffs and all the auto executives who started crying and screaming and saying, "Oh
Panicking,
no, cars,
panicking,
right? Yeah, cars aren't going to
panic.
be right. Every car is going to cost 7,000 more, 10,000 more. Nobody's going to be able to afford cars." You remember all of the
Oh yeah.
craziness? Yeah. Yeah. Well, guess what? They were wrong about that. We actually have lower steel prices. So again, the reason that these economists are consistently wrong is because they do static analysis, right? They say, well, if we increase prices, you'll lose demand and it'll all fall apart and we'll all just pay more. But the dynamic analysis is, wait a minute, if foreign supply is more expensive, we'll get more domestic supply. And as people shift, right, we just end up with more domestic supply. And it's one of the key reasons why, despite the fact that in US history, we have had multiple rounds of tariff expansions, it often doesn't lead to widespread economic disasters, right? Or at least nothing trackable. And the guy who did, I think, really great work on this, we've talked about it before, Anthony Pompliano, did some really interesting work. He took a look at the history and found a whole bunch of examples of where the US had raised tariffs, but prices didn't go up. And the reason he found was more domestic supply. That's exactly what's happening here. Surprisingly, the automakers are not complaining this time around, or at least not that I've seen.
So in the DKI five things, you mentioned residential construction, which increased in 2024, and now we actually have a near record amount of new homes for sale, topping out where we were in 2008, and which again is gonna kind of show you where that demand is. But even more than that is also commercial real estate. And if you look at the commercial real estate market, nobody's building new commercial real estate. I mean, you have things that are selling at fire sale prices. So there's really no huge, absorption of this capacity until we start seeing some of the bigger build outs from Facebook, Meta, Google, Amazon, when you start looking at these data centers. And it's great that you brought up cars, because one of the biggest things is, where EV is going to come in. And the reason why electric vehicles matter so much is because weight is such a huge concern, because the more weight, the less distance, the more wear and tear, because you want to keep that as light as possible. So you have more plastics, more aluminum. So when you start looking at the slowdown in demand, I think Mercedes shuttered four of their five EV production for the month of September. They're even considering, do they even want to have some of these lines going forward? Because we've essentially capped out at about 9.7% demand for EVs. So then you have this reversion back to people want SUVs, they want pickup trucks. So that is going to be a bit more steel when you think about the frames and the like, which could provide some semblance. But realistically, as we always joke about when commodities, the cure for high prices are high prices. And because you're going to bring back more production, you're going to slow down some of that demand. And then as the prices come down, you find what we like to call a clearing price. A price in which, I can't turn that down. I have to buy here, even if I store it, because I can't, this is something that I may not get for the next 24 months. So when you start looking at some of the build outs that are coming, because we are getting that onshoring, we are getting some of these mega builds. When you look at the deals that have recently been signed by Google, Meta on the manufacturing AI front, that's when you can start to see some of this absorption. But until then, it's going to be difficult, and maybe at this point you're just going to see a more overhang, especially as China starts to dump some of their steel into the market, because they're also looking at a huge supply glut that they're going to have to do something with.
Yeah, it's really interesting that you talk about when a price hits a certain level, you have to store it. Just last week, we were talking about futures contracts and explaining it. And I talked about, the hilarious example, and every young trader gets schooled on this, where somebody bought futures contracts. They got excited because they were in the money. Oh, good, I made a lot of money. But they forgot that commodities futures deal with actual physical goods. They forgot to sell the contract, and some trader on a floor would get a phone call saying, "Hey, where do you want this enormous quantity of wheat delivered or corn delivered?" And they're like, "Wait, what?" It didn't
Yeah.
occur to them that they
Take
weren't
delivery.
trading, right? They weren't trading numbers on a screen. They were trading an actual thing. You had to take delivery.
Yep.
And, I remember back in 2020 when oil prices went below zero,
Hmm.
right? And
Oh
and
yeah.
because everybody was producing, and all these governments shut down their economies and told everybody, don't go to work, you can't go to school, right, everybody stay home, nobody do anything. And which was idiotic, but at any rate, we end up with a situation where you had so much oil supply, oil prices went negative. I mean, how can prices be negative? If you had a truck and you went to where they had oil, they would pay you to take the oil away. And I remember I had friends saying to me, "Well, wait a minute, oil's negative. They'll pay you to take it." I'm like, "Yeah, if you
Yeah.
go pick it up, they'll pay you to take it." And they said to me, "Why don't you buy oil then?" I said, because where am I going to store it on my front lawn? Right? Like, I guarantee you the town of Westport, Connecticut has rules about storing industrial quantities of oil on
Oh
your
yeah.
front lawn. You need somewhere to put it. You actually have to go pick it up. It's a thing. And
Well,
so, this is we were just talking about this a week ago.
oh yeah. I mean, we were joking about how do we line the pool, a pool to handle additional oil and just start pumping it into it. And I always think about the Always Sunny in Philadelphia when they're trying to be oil men by reselling gasoline. And I just think about the absurdity of people not understanding the different types of contracts. Because to Gary's point, there's two types. There's the financial instrument, which is Brent, where you're not really going to take delivery. And there's WTI, which you're taking delivery. And if you aren't very astute about when your expiry is coming up, you then have 3 days to sell after expiry and what's called the gray market. And as somebody who had participated in a lot of these different things, because I did trade physical as well, I would look to pick those people off because the only person you can sell to is me. And I'm not going to pay you top dollar at what that expiry is because I
Yeah.
know you sitting somewhere, sitting on 5 contracts, not realizing what you just did, have no means of taking delivery of that. So that was always a good day when I could dip my toe into the gray market and alleviate some of those concerns for some people that got stuck wearing some future contracts that they didn't manage very well.
So wait, when you were talking about filling a swimming pool with oil, which isn't bad, like, I mean, my pool at home probably fits 20,000, 22,000 gallons. That would be something,
It's
right?
meaningful.
But how long did it take you guys before you started talking about either saran wrap or garbage bags with duct tape? Because
Well,
I
that
know
was
those came up.
Well, that was why I sent everybody the Always Sunny in Philadelphia episode where they had those big blue barrels and they were filling them up with gasoline and trying to sell it door to door at a discount because there was one place that was selling it at a discount and they thought they could capitalize. So they had 3 of those big blue barrels. I'm like, we could do that with oil. I was like, we should do that with oil. There it is. But yeah, not so much. One of the things as we move forward, a lot of times in order to have a futures ability or to be able to partake in that, you have to have margin debt. You have to have a margin account. And in previous lives, a margin account was only for what was deemed a sophisticated investor, somebody that they believed could manage that debt or I should say that leverage that was going to be rolled out, whether it be in options, futures, shorting stocks, which is when you make money when the stock goes down because you have to get a borrow. There's a lot of complexity, but now we've seen more and more people get approved for margin debt. Robinhood is one of the ones that made the news on multiple occasions where people were putting in $10 and then buying $10,000 worth of options. And that's where you start to see people get into trouble. But as Gary wrote, and Gary and team, I should say, wrote about how we are now at a record of $1.02 trillion of margin debt. It means people, if it means that, for an example, if IBM goes from 100 to zero, you lost $100. But if you did it on margin, you didn't just lose $100, you lost $120. So even though you got wiped out, you still owe the company $20 because you borrowed. And as rates go up, the cost of borrowing goes up. And those are those hidden pieces that people don't really pay attention to. Now, Gary, turning it over to you, what do you think that means for the stability of the market? What do you think that means for a continuation of this movement higher? Or could we get people getting near cost price, panic, and have a fire sale, and then you have a buyer strike sending the market lower?
Yeah, so this one's complicated, Mark. The fact is, investor leverage has just hit a record amount. As you mentioned, total FINRA margin debt is 1.02 trillion. That's up 26% year over year. And I view I view margin kind of like I view alcohol. If you use it wisely, it can make things really nice.
Mhm.
If you use it poorly, it leads to disaster. And I told this story on the five things once before earlier this year, but I was talking to somebody. We did a segment, an educational segment on margin debt. And, I was talking to a friend of mine who he was trading seven figures worth of Apple stock at a time. And one of the things he said to me was he was really excited because his brokerage had this really amazing new thing called buying power. And he had buying power that was in excess of his account. And I said, okay, you didn't discover anything new. You're just taking on debt. It's just leverage. They're charging you interest and you're taking on more risk. And that's the key thing here. So on the positive side, people can take on more risk and they can have larger positions as long as they can pay the interest on it and cover potential losses. And a lot of people will say, hey, listen, you got a rising market that'll create some growth in margin debt. Okay, fair enough. Margin limits will increase with more buying power from good returns. Okay, like fair enough. That's not crazy. Inflation, larger balance sheets, higher equity valuations, they all make margin levels manageable. Some people might say that more people buying on margin is bullish. And I'm assuming, Mark, that these are people who are buying. These are probably not people who are hedging or taking short positions or doing something to lay off some of the risk, which is the difficult thing. Um, in this situation, I would advise caution. Credit spreads are unusually tight. The VIX is low. All of this means the market is pricing in continued calm. That means valuations imply no concern regarding economic growth, inflation, employment, potential tariff issues, AI profitability, and rising consumer credit losses. Okay, so, Mark, I use margin when investing, but I also have enormous hedges in place to ensure against market drops, to ensure against higher inflation, right? I'm not just betting it all on black. And so, if you're using margin to control your risk, that's one thing. If you're using margin because number goes up, means number will always go up, you're going to be in trouble. And so I guess if I have to sum it all up in one sentence, I just say it's important to remember that margin amplifies your returns, both positive or negative, and margin calls will always come at the worst possible time, right? So if you're on margin, it's going to amplify your returns when you're down. That's when your brokerage says, hey, we've got a margin call. You need to start selling positions that you've lost money on to raise cash to give us additional security against your loans. And people don't think about that. They think about buying power. They don't think about the fact that a margin call, by definition, will come at the worst possible time. It doesn't come when you're up huge. It comes when you're down.
And one of the key pieces is you don't have a choice because if you don't make your margin, they will force liquidate. And to
Right.
your point, you're going to force liquidate at probably the low because everybody's going to be forced in at the same time. And that's why you'll see running jokes on Twitter or the like where it's like, oh, somebody got a call from the margin desk because you're going to have to increase your position. one of the interesting things that you talked about is the VIX, and one of the things is hedge funds in particular have been shorting the VIX, in size, some of the largest since the really the end of 2022. So when you start looking at the VIX, you can also artificially push things down, and I think you listed a lot of the things that are equity focused. But one of the interesting pieces is the bond market isn't showing the same level of security. When you look at the 2 year, the 30 year, and the difference between the two, you're starting to see a lot of cracks. You're starting to see some of this concern. And when you start looking at what Powell is saying, when almost like guaranteeing that we're going to have these rate cuts, when you have inflation that is, as we discussed last time I was on, well above 3%. You have home prices at all-time highs. You have, stock prices at all-time highs. You're almost ushering in a Nixon level, or what we would call the third wave of inflation. Because if you go back in time, when you had that last surge that ushered in the age of Volcker, that was the third one, where you had these first two humps. Both of them were big, but then the third one really blew off the top. And if you look at some of these pressure points, these are some important things where, and some people believe, oh, well, Powell's going to cut rates, therefore my borrowing will go down or my rates will go down. It's like, that's not how that works. The
No.
market sets rates. And you could see some of these pressure points where guys are going to start getting concerned, and they're going to do what they call, which is increase the cash balance that you have, or increase the margin that you have to own or pledge in order to have some of the positions, especially as the market starts to get a little wonky, whether it's volatility increasing or things starting to get a bit extended, which again could call people into a position that they don't want to be in.
Yeah, it's incredible. People keep talking about, we need Powell to lower rates, so mortgage rates will be lower. So so their credit card bills will be lower. That's not what happened last time. It is amazing. Again, we just like we were saying, hey, I'm old enough to remember just a few weeks ago when the automakers went crazy, on steel prices, or potential steel prices, not actual prices. This was less than a year ago that the Fed cut. And what happened to the 10 year? The Fed cut the Fed funds rate by 100 basis points. That's 1%. And the yield on the 10 year went up by 100 basis points, 1%. The market priced in higher future inflation. So, these are issues that for whatever reason people just seem to not understand.
And when you think about the complexity of it, as we kind of pivot over to Nvidia, which had very good earnings, I mean, across the board, but yet it fell. And it's interesting because there's a famous quote when you start trading in the market aggressively, where it's like good news, bad action. And if you have good news, bad action, it means that everything good or anything positive has been priced in, and people are now selling the news, where they're like, okay, this did what I expected it to do. There could be some forward pressure, so I'm going to lessen my position. Or what also happens when you think about managing the portfolio, that this position has done so well, I now am overweight where I want to be, so I need to sell to get my position back into balance with how I want my portfolio to be constructed. And if you look at Nvidia, and if you look at some of the different pieces, you've had this big run. You obviously have the Magnificent Seven, which is essentially the S&P 500 movements at this point in time. But when you start looking at this, Gary, on how you're viewing Nvidia, is this are we at a changing of the guard, where people who have been there for the long haul are like, look, we're maxing out, and they're trying to lower their position? Or do you think that there is some potential next level moves based on the strength of Nvidia, the fact that they got the deal that they wanted with China? Or was this something where you're like, you know what, sell the news, capture your gains, and walk away to something new?
Yeah, so I think the reaction of people like on Twitter or X was fascinating for this one. First, let's just start with the basics. Nvidia had a spectacular quarter. The fundamental performance was over the top amazing. We're talking about just under $47 billion of revenue. That's up 56% year over year. GAAP net income of over $26 billion, adjusted earnings per share of a $1.05. That was above estimates. Revenue from the new Blackwell data center AI platform was up 17%. That doesn't sound like a lot, except it was 17% sequentially. It's over the prior quarter. The board approved $60 billion of stock buybacks. I mean, it really was incredible. And so, I kept seeing people on X saying, I don't get it. The performance was phenomenal. They beat estimates. Why is the stock down? And, the stock didn't crash. It was down like 2-3% in after hours trading. And it was down a little bit the next day. Nothing awful. But the answer is because all the good news was in the stock, and people act like there's no base, like there's no valuation that matters. Like, well, they beat, so the stock should go up. Well, the stock price was assuming that they would beat, right? The stock price every quarter, Nvidia, they give guidance, or people have, yeah, they may be giving it under the table, quietly to the sell side, but they beat every quarter. And so people are expecting it. I think the primary reason the stock was down, Mark, and the place where you might see potential benefit in the future was the expected data center revenue and guidance included no H20 chip sales to China, right, for the next quarter. And so you've got this geopolitical uncertainty. And the thing that I think is really interesting about this is, the Biden administration said, hey, we're going to put limits on what you can sell to China. And so Nvidia, they got a little bit clever, and they found a way to deliver chips to China that were almost as good as the chips that got banned. They complied with the regulations, but they were in technical compliance, right? They were technically correct, which is the best kind of correct. Anyway, for all the Futurama fans out there. So, that didn't really work. And then, the Trump administration said, okay, well, we're going to ban this. And by the way, China found 17 ways around those restrictions. The restrictions did nothing. China was buying chips on the gray market. They were having chips transshipped. They were they were buying fractional time on, other people's chips. They found a million ways around this. And so, the Trump administration said, we're going to stop this. And then China said, okay, no rare earths. And then they had to trade. And so they said, okay, will you give us rare earths? We'll let you buy the H20 chips. And everybody said, okay, yeah, that seems like a good solution. And then China, after fighting to get access, said, no, those chips have spyware, which I find hilarious coming from China. But at any rate, so they said, okay, well, we don't want to buy these. Now, I suspect, and I don't know this for sure, I suspect the reason China doesn't want to buy the H20 chips is because they're buying the Blackwell chips, right? We saw a situation, God, what was it, a year ago, where some town in Vietnam bought more chips, more Nvidia AI accelerators than they had electrical infrastructure to run it, right? That if everybody would have turned off all the lights, all their air conditioners, everything, and just simply tried to run these NVIDIA chips, they didn't have enough power. Now that stuff's getting shipped to China, right? So that's where there actually is some potential upside, because right now the guidance includes nothing to China. What do you think is going to happen here?
So I'm cautious because so my business, at C6 Capital Holdings, we invest in power infrastructure, generation, and on the fertilizer side, energy infrastructure in total. But our main 90% of capital goes into power. And the biggest hindrance right now is power attributes and power availability. So when you look at PJM, which is Pennsylvania, Jersey, Maryland, which is essentially the key because it's called what's called an ISO, which is an independent system operator. And this is an entity that has no jurisdiction across, it goes across jurisdictions. It's looking at a swath, and within PJM is 13 states, different factions. And their power sales for 26, 27 went out at a maximum, which means that they set levels where they say, look, no matter what, you can't go over this price. And it's usually multiple standard deviations. So you'll be, surprised to know it usually doesn't get hit. And we've seen it over the last 2 years go from $120 a megawatt hour to $329 a megawatt hour, which is a massive move. And it's really coming down to power being the biggest hindrance. So to your point on the resale, because obviously Vietnam's buying them, putting a different flag, sending it over to China. In the US, we've purchased a significant amount of chips, but right now we don't have a place to put them. And that is going slower than expected. And now you have this new iteration of, well, what is the profitability of a data center? And if you remember back when the internet first started, or I should say, really became commercialized, you had all these dot coms popping up everywhere, but nobody figured out how to make money. Like, how do you turn a dot com into a profitable business? And now you're having AI kind of go through this same change of like, okay, I have all this capacity. I have this AI training. I have this AI inference. And for those that don't know, an inference is when you actually query it. The training is when they take those queries and when they generate something and then learn themselves. So each one is going to consume a different type of chip. Each one is going to consume a different level of power. Inference being lower, AI training, which is usually continuous, is going to have the highest. But what do we do with it? Okay, we have it. I see it. But how am I going to parlay this into something like, are you going to use Google over something else because you have access to Gemini? Are you going to buy an Apple product versus a Google product because you like their AI better than others? For me, a summary of my email is pretty simple. It can be just as good on Apple Mail as it is on Gmail or Outlook. And then there's this unknown now of what am I dumping money into? So I think when you start looking at the stock in general and these buybacks and the like, it's like, okay, well, what's the next iteration? Like where am I going to get the next level of value? Because is everybody going to take delivery of these chips? Can they deploy them in a meaningful way? What's going to be the growth in 2026, 2027, where I can already tell you power prices are two standard deviations above what they were last year? There's a lot of unknown, and I think that is why you're starting to see some of this hesitancy in terms of where that next price level goes when you start looking at stock prices across some of these magnificent seven, because you saw the same thing at AMD. You're starting to see this exhaustion of, to your point, it's baked in. Okay, now what? Like, what am I excited about to get this to the next pricing level? Because I just don't see that growth over the next, let's call it, 2 to 3 quarters.
Yeah, one thing I think is really interesting, Mark. If we go back to the original dot-com boom, people said don't buy the dot-coms, buy the pick and shovel guys. So everyone was saying go buy Cisco or Nortel. That didn't work well. It worked until it didn't. And then, this time around, people are saying, well, again, buy the pick and shovel guys. So Nvidia, has done great, saying go buy AMD, also great. Supermicro, great until it wasn't. Dell, great until it wasn't. Some of these have done well, others haven't. But the way that we've played it at DKI is in that Pennsylvania, New Jersey, that interchange there, the PMI, we've owned Talon Energy, which owns the nuclear plant that's selling power to Amazon, at the meter, behind the meter. By the way, credit to Enrique Abeda for that idea. We did a webinar with him on that. But, we bought that stock at 115 and last year, and it's tripled since then, more than tripled actually. So that's gone well. And then long term, I own a huge amount of uranium because that's going to be the solution. You're not going to be powering AI data centers with solar or wind. Nobody is going to get permitting to build a new coal plant or natural gas plant in the United States. It is going to come down to nuclear. And so, we can debate who the winners are going to be there, but they're going to have to use uranium. So we own huge amounts of that. And that to me is the ultimate picks and shovel play, right? To really own the infrastructure, because without energy, nobody's getting anything done.
Yeah. And that's where, selfishly, that's what we created C6 to do in 2019, because we saw this new iteration. I can't take credit for seeing AI. I did not. But we believe data centers were going to be a big thing. We've talked about EVs. You've talked about there's electrification mandates. So you have a chip or this hardware or this AI that is kind of coming in from the background and competing against these electrification mandates, which is where states are trying to get people away from natural gas, using electric heat, using electric stoves, electric everything, EVs, putting in superchargers, and you're competing. But remember, AI, even though power is a huge price to them, they're price agnostic, and they've proven that time and time again because they're willing to pay well above market rates, as you talked about with talent, as you talked about with nuclear, because remember, there's AI training and AI inference, and AI training needs 90% utilization factors, which just means how often does that power plant run? And to your point on uranium, you'll be shocked to know nuclear has the biggest uptime with the least amount of disruption, which is why they're trying to tap into these resources, and we're going to have to do it on a bigger scale. The next would be natural gas and coal. And then obviously, as you continue to go, then it's hydro. Then you have, solar and wind, which is far to the right. So you're seeing some of these issues coming up. But to your point, I like the pick and shovel where let's just say you did great in Nvidia. Maybe it's time to go to that second and third derivative. Look at where the copper is trading and copper miners. Look at where power producers are, because that could be the next iteration. Because okay, you got the front end. Now we have to build out the infrastructure. Back to the steel comment. Where's the infrastructure going to come to? We're going to have to build, some of these new wire lines. We're going to have to build new facilities, which all of it is built on steel. All the wires are going to have copper. So these are things to think about when you're looking at, I just crushed on Nvidia, now what? And that's where this can get very interesting.
Yeah, great points. Thanks.
So when we start looking at ways to measure stocks, now I am not a huge fan of price to equity, which is the PE ratio, because as somebody who is just like listeners here, and as Gary knows, we've been through a lot of boom and busts, and PEs can get really high and they can get really low. And one of the running jokes when a company is not doing well, cheap can get cheaper until it's bankrupt. And just like Nvidia and the Magnificent Seven, expensive can get expensive to get ludicrous. And so you almost have this FOMO, or fear of missing out, where you have these ratios that can explode to the upside. And it's a good metric because you have to base it on something, but it should always be paired with other things. And I'd be interested to know, how do you think of PE value? How do you kind of factor that into your evaluation of a company and a stock?
So I think this is a really important topic, Mark, because it's one of the most basic ones. The PE, the price to earnings ratio, it's one of the most widely used metrics in investing. And I'm going to tell you about a conversation. I had lunch with a friend of mine a number of years back, and he invests, and he had, a decent sized account. He had a 7-figure account, and he's investing all the time based on what they say on CNBC. And he said to me, "Hey, can I ask you an investing question?" I'm like, "Sure, yeah, what's on your mind?" He said, "What's this PE ratio they keep talking about on CNBC?" And I realized, oh my God, this guy's trading, millions of dollars of stock on a daily basis, but doesn't know what this is. And it's really important sometimes to just go to the basics for people. So let's unravel it for people and just help them understand. So PE stands for price to earnings ratio. The price is the price per share. The earnings is the earnings per share. So if you take the net income of the company divided by the number of shares, that gets you your earnings per share, your EPS. If you have a stock that's trading at 20 and the company earned $2 of earnings, their EPS is $2, then it's trading at a 10x PE ratio, which is just a fancy way of saying that you're paying $10 for every dollar of earnings that you're getting from the company. Now, the reason a PE ratio is a useful indicator in the realm of market expectations and sentiment is because it does tell you what the market expects for these companies. In general, a high PE ratio will be assigned to a high quality company and one where you're getting a lot of earnings growth. In general, the bargains, as you pointed out, it cheap can get cheaper and cheaper and cheaper all the way down to zero. And
Yep.
you don't get a big PE multiple on companies where earnings aren't growing, the opposite of Nvidia, right? Where the earnings are
Mhm.
shrinking. And so these are things that you look at, and it does give you a sense of how the market is valuing different companies. Now, I think one really good way to use the PE ratio is compare it to the company's growth. Another good way to do it is compare it to other comparable companies. And so if you see a situation where, one company in industry has a very high PE ratio, but the other
Yep.
companies in the industry have much lower ones, there is a reason that there's an outlier. Now, that reason could be wrong, but it does say to you, you need to go find out what this is. And
Yep.
we saw this. This was a number of years ago. I invested in some of the health insurance companies. I'm not involved in them right now. But a situation where that we looked at, one of these companies was trading at a much lower PE ratio than the others. Now, in this case, the reason for the discount was wrong, but you
Mhm.
needed to understand the reason to know why you were investing in the stock. And that was the thing that mattered. People were looking at this wrong. And that's what created the opportunity. The one other thing that I'll tell you is there are situations where the PE ratio does lie to you. So in the case of cyclical companies, you typically want to buy the stock when earnings have bottomed and sell the stock when earnings have hit their cyclical high. But just remember that when earnings have bottomed, you have a very high PE ratio. And when earnings are high, you have a low PE ratio, and that's the signal to sell. So again, it really depends on the business, it depends on the industry. The last point I'll make on this is, and this will be hard for amateur investors to do, but it is worthwhile to go through the income statement with a fine-tooth comb and do your own version of adjusted earnings. Now, companies will give you adjusted earnings, and I promise you the adjusted earnings are almost always higher than the GAAP earnings, right?
Mhm.
The adjustments only go one way. It's kind of like
Yep.
the government giving you the CPI, the Consumer Price Index. They never adjust it down. They never adjust it up. They only adjust it down. They like to make inflation look lower than it
Yep.
seems, right? But there are all kinds of things that companies can do to screw around with their earnings per share. And that's a very long, complicated, accounting heavy question that is it's far too much to talk about in an educational segment here. But there are all kinds of ways that companies can play around with it. And so if a company artificially increases their earnings, but it's not sustainable, it's going to look like the PE ratio is lower than it really should be. And it'll look like you're buying the company at a discount when you're not. So it is worthwhile, and it can be tough, like I said, for amateur investors. But go through the income statement, see
Mhm.
if everything sort of passes that sense of smell test, and see if there are things that maybe you want to adjust. It's also worthwhile to take a look at the cash flow statement. If the whole thing is daunting, then just look at the first part of the cash flow statement, cash from operations. Sometimes you see things there that you might want to use to adjust your earnings to get a more accurate PE ratio. But those are my thoughts on it. How are you using it? Or maybe you don't.
So I'm similar to yourself, and I think you bring up a great point of looking at it from the perspective of industry specific. You can't compare an Nvidia to a GE, just like you can't compare a GE to a JP Morgan. You have to look at the industry that it's in other cyclicals or under high or equal high growth stocks, because otherwise you're going to be comparing apples to oranges, and you really want to keep things specific. For me, obviously it's an important metric, but not an end all and be all, to your point on cash flow. I care more about what is my free cash flow, how much money is the company generating, because I think one of the key components, and as I don't want to get too far into it because, as you said, it's a complicated topic, but one of the key pieces, especially because we talked about Nvidia and the buybacks can be used to really skew this, and it's really you're leveraging the balance sheet where you're borrowing against it, and then you're buying back stock to really kind of manage that. And we go into to your point, the balance sheets, the cash flow statements, the income statements to really look at, okay, what is my cash flow? What is my cash flow after interest expense? So essentially, do you have a great price to earnings ratio because you're buying back stock, but you're doing it with borrowed money and the company's actually losing cash? And I think that is the big piece of what is the use of capital. And a company that is really good at the use of capital is going to be reinvesting in R&D, investing in that distribution, investing in growth. Because personally, and this is always a back and forth, I'd rather get paid for owning your stock. I want dividends. I want to know that you're rewarding me for this growth. I don't want you to reward someone selling the stock where it may make my portfolio look really good because it's going to artificially keep that stock higher, but just pay me for owning it in that income stream. And I think it's going to be an interesting setup when you start seeing the boomer generation retiring, looking for those income streams on how do companies address, because in the past it was buy back stock, increase price per share, and that's great. But now, are we going to want more income generation? Back to kind of where we were in those 50s, 60s, 70s until we started to get into the 80s and 90s where price per share mattered way more. And I think that's going to be an interesting pivot over the next decade as people start to retire and look for that fixed income stream.
All right. Well, that's a great point. The only thing I'd add to that is that stock buyback does result in income. You just have to sell some stock to do it, but at least then you have
Exactly.
control of your tax situation. But
Yep.
at any rate, that was an educational topic from a couple of months ago. We actually did the dividends versus buybacks capital allocation one for people. Anyway, I think those are our five things here. Time to get it wrapped up. Want to thank Mark Rosana, the CEO and founder of C6 Capital, for being our guest host. We'll have Rob Farian of Flying V back in his usual regular hosting spot next Monday. We should have this one up on Tuesday morning for you. Hopefully, we'll have Nazim working on that. Also, want to give credit to DKI's interns, Cash and Crow, Samak Jain, and Gideon Rodham. As usual, they do phenomenal work, and so much of what you guys see here is a result of work that they've done, which we really appreciate. And then finally, if this was useful to you, we'd appreciate it if you give us a like and subscribe. But hey, do what you want. We're not the boss of you. We'll look forward to seeing you next week.